Good day, welcome to today's class. If this is your first time on this channel, please click on the red subscription button to subscribe to this channel so that when I drop more educative content, you will get notified. So in today's class, I have something very interesting topic to teach you guys. And as you can see on the board, our topic for today is transfer pricing. Now, I will explain what brought about this transfer pricing and how do we see questions on transfer pricing and how do we solve them. That's what I'll be treating in this video lecture. So now, what is transfer pricing? Transfer pricing is simply the price at which one division is transferring to another division. Let me explain. Let's say, for example, now we have a very big organization that's into let's say they are into a very big organizations that's into selling of cars. Now, this organization sell cars. Let's say now these organizations, they have two different divisions. They have division A and they have division B. So division A and we have division B. Now let's say division A is the one in charge of producing the car engines. So division A produce car engines, and as you know, we cannot sell car engines alone. Yes, we need to couple them together and make a car so that we can sell to the general public. So division B is the one that couple the car, that put them together, put every other part together to make a full car. So this one deals with what? Full car. This one reduce car engine, but both manage separately. Now, this one has its own manager, it's independent. This division also has its own manager, it's independent. Now, you accept with me that for this division B that's in charge of producing full car, for you to be able to produce car, it needs the output of this division. Yeah. So this division produce engine. So this one has to either sell to outsiders, sell to other people that manufacture cars, or sell directly to this guy here. So transfer price is the price at which this guy now decide to sell to this guy. Let's say this one has a manager. The manager for this is Mr. Frank. For this division is Mr. Frank. The manager for this division is, let's say, Mr. Edoho. Now, the objective of every manager in any organization is to increase shareholders' net worth, or to increase profit generally. So this manager here is willing to increase the profit of this division. This manager here is willing to increase the profit of this division. So this manager here will be willing to buy at a lesser price from this division. But this manager here will be willing to sell at a higher price for this division for them to maximize profit. So that's where the issues comes in, is that what price am I going to sell to you? No, I want a lesser price. No, I can only sell at a higher price. That is what transfer pricing is all about. So what we determine majorly here is the price at which one division will be selling to another division in another organization, in the same organization rather. Don't forget that they all belongs to one organization. So this one not selling at the right price to this, or this one not buying at the right price, can eventually affect the general profits of the organization, because this profit plus this profit give us the general profit of the organization. So if there is issues with the transfer price, then it can go ahead to affect the general profit of the organization. So for us to be able to determine the price at which you are going to sell, this division is going to sell to this, is what we call the transfer price. Now let's proceed. There are different ways by which goods can be transferred, or prices, goods or output can be transferred. Yeah, first one I will mention is what we call full costs. Yeah. So number one is that goods can be transferred at full cost. Let's say the cost of manufacturing an engine here, sorry, in this organization, cost of manufacturing an engine, the variable cost of manufacturing an engine in this division is, let's say, 300 naira, and the fixed cost of it is, let's say, 700 naira. So if we add it together, we have 1,000 naira. Then if this division is decide to sell to this division at full cost, this is full cost, selling at 1,000 naira, 300 naira variable cost, 700 naira fixed cost, making 1,000 naira. So now another one is what? Full cost plus margin. Full cost plus margin. Now, another way at which you can sell is that we can say that, okay, this is the full cost of production. let's add maybe 10% of it will be our profits. 10% transfer markup. So 10% of 1,000 is 100. So 1,100 will be my transfer price from this one to this one. So this is full cost, and you are adding an extra percentage. So we call it full cost plus margin. And another one, which is the most popular one that we use majorly when we deal with transfer pricing, is what we called marginal costing. Now, I need to say this marginal cost, which is also the variable cost. Now, I need to say this for you to be able to understand this transfer pricing very well. You need to have understand the concept of marginal costing and absorption costing. So, if you have not watched the video on marginal costing, or you don't know what marginal costing and absorption costing is all about, I'll drop the video right under this video. So, make sure you watch out for them for you to be able to understand. Because I'll not be explaining this in details in these videos. I've done that earlier. So, let's proceed. Now, so another one is just the what marginal cost or the variable cost, by saying since the variable cost is 300, the fixed cost is 700, let's transfer from this guy to this guy at just the variable cost. So this is what we mean by what marginal cost or variable cost. So when we get there, I will explain the rules for setting minimum price, because one of the questions you should expect under transfer pricing is that they will ask you that what is the minimum price. They will give you information. They will now ask you what is the minimum price this division or division A should set for division B. So what's the minimum price? How do you calculate the minimum price? How do you go about it? Let's see. Welcome back. So as I was explaining earlier on, whenever we want to transfer from a division to another division, there are some things we must consider. Yeah, there are some basic things we must consider. And firstly, I will state the rule of transferring or of setting the minimum price. I'll write it on the board for us. Then we look at questions. We look at some other questions, areas we should expect on transfer pricing in our subsequent videos. So let's go. What is the rule or what is the basis for setting a transfer price? Like I said earlier, transfer price is the price at which one division is selling to the other division. So what is the basis? What do we consider in setting this transfer price? Number one thing you need to consider is in setting any transfer price, the first thing we need to consider is the marginal costs. Yes, so marginal costs, marginal costs of the transferred output. Transferred output. So this is the first thing we consider. And another thing we consider is the opportunity cost. Opportunity cost of transfer. Opportunity cost of transfer. Now, I'm going to break this down so you don't have any problem. I'm going to explain it. After this video, you will understand it for sure. Now, the first thing we need to consider is the marginal cost of the transferred output. What do I mean by the marginal cost? You see, in costing generally, we believe that, or some scholars believe that the most important costs that we should reckon with, the relevant cost, is the marginal cost or the variable cost. Yeah, and let me explain. Let's say, for example, now I have a particular building I used to produce. Now, this building, let's say I rented this building for 7 million naira. Now, I rented this building for 7 million naira, and this building, this rent is my fixed cost. But the amount I spend in producing every day, let's say, is 7,000 naira. I spent 7,000 naira every day in producing, but I spent 7 million naira to acquire my facilities and everything, which is only once in a year. Now, this cost is not relevant in making decision. Why? Because even I don't need this 7 million naira every day to produce. No, all I need to produce is this 7,000 naira. So for me to be able to make any decision, I must be able to at least cover this my 7,000 naira. So we believe that, or some scholars do believe that, the fixed cost is not really a cost that we should consider when making decisions. So we should only consider the variable cost, which is the cost we need. We needed it to be able to do our videos. So sorry, to be able to make our goods, like the cost of materials, cost of petrol, lighting, cost of laborers is this 7,000. So if we don't have all those ones, our laborers will not produce. We will not be able to get our raw materials and so on. So this price is very important. So the first thing you need to consider in any transfer pricing question, whenever they ask you to find the minimum price, the first thing you need to consider is what is the marginal cost, what is the variable cost. Let's continue. Now, Another thing you need to consider is the opportunity cost of transfer. And I'm going to explain this one very, very well so that you get it. Now, what do I mean by opportunity cost of transfer? Opportunity cost of transfer is that, let's say, for example, now, this is division A. I love working with examples so that you get it. This is division B. Both the same, under the same company, the same organization, but different divisions managed by different managers. Good. Now, division A can only produce, division A is the selling division rather, selling division. That means that this division is the one selling to this division. So this one is the buying division. So in your question, sometimes you might not see it as division A. They can tell you that this A is selling division. That means that this is the one producing the raw materials. Why this is one is the one buying the raw materials. So division A selling division, division B buying division. Now, division A has a full capacity of 40,000 units, or let's, yeah, 40,000 units. 40,000 units. Now, division A has a full capacity of 40,000 units. That means that the total amount of goods it can produce is 40,000 units. Now, division B needs, let's say, 30,000 units. Now, you agree with me that division A produces 40,000, division B produces 30,000. Don't forget that this one, or let's say this one, even this division A engage in producing car engines. You know, car engines does not really have large markets compared to cars itself. So sometimes the selling divisions does not have external markets. So when solving questions on transfer pricing, you need to ask yourself, does this selling division has an external market? So let's say if you have been told in the question that yes, there are external markets for this selling division, now there are some things you should do. And if you have been told that there is no external market, there are some other things you should do. Now, if there are external markets for this division, let me start with that. There are external markets. That means that division A can decide not to sell to division B, can sell to other customers. Now, if division A wants to sell to external markets, the selling price for external markets, let's say, is 1,000 naira. Now, and the variable costs, let me say the variable costs of producing, don't forget that I said the selling price is 1,000 naira. The variable cost of producing one machine or one car engine, let's say, is 400. Let me put it that way, 400. Now, if I want to sell 30,000 units to division B, and let's say, okay, let's say my external markets, they can buy the whole 40,000. That means that if division A produce at full capacity, division A can sell the whole 40,000 naira, 40,000 units to outside, to external market. So let's say demand is also 40,000 units. Please, I hope you get my illustration. 40,000 units is the full capacity of division A. Selling price of division A is 1,000. Variable cost is 400, and demand for division A is 40,000 units. That means that division A can still live, can still do fine without division B, because division A will sell to external markets. Now let's proceed. Now with this illustration that is here now, if division B wants to buy 30,000 units from division A, that means that division A will not be able to sell this 40,000 units to external customers anymore. Will not be able to sell it to external consumers or external market anymore. Rather, division B will now only be left with 10,000 units. Because if division B wants to buy 30,000 and division A only produce 40,000, that means that division A will only be left with 10,000 units after selling 30,000 units to division B. Now, the first question you will ask yourself, what is the marginal cost of this transfer? And the marginal cost is the variable cost. So the marginal cost of this transfer, what is the variable cost? Is 400. That is the relevant cost. We need to reckon with that. So the marginal cost, the variable cost at which you will transfer to B, is 400, which is the marginal cost. Then the opportunity cost. The question is, what is opportunity cost? Opportunity cost is just the foregone alternatives. Yeah. If division B, or if division A rather, is selling 30,000 units to division B, now at 400 naira each, the question is, how much is division A losing on each product it is selling to division B? Now, the current price of division A is 1000 naira, but division A wants to sell to division B at the variable cost, which is 400 naira. You agree with me that if division A is selling to division B for 400 naira, division A is losing 600 naira on each product, because on a normal ground, division A can sell at 1000 naira to external market. So selling 400 naira to division B means that division A is losing a whooping 600 naira. So now that 600 naira is the opportunity cost. So the marginal cost or the variable cost is 400 plus the opportunity cost per each. Opportunity cost per each is 600. So making 1000. So the transfer price that division A will be transferring to division B is 1000. Variable cost plus opportunity cost. Now, so this 1000 naira is the price at which division A will now be selling to division B. Now let's now use another illustration. Let's say the external market, or let's say there is no external market for the goods at all. Now, so these are things you need to consider whenever you are solving questions. Let's assume there's no external markets for division A at all. So division A cannot sell to external market. Division A can only sell to division B. Now, and division A produces 40,000 units. Let's say it still produces 40,000 units. Division B only needs 30,000. Now, let's calculate the transfer price. The transfer price will be, what is the price division A, sorry, what is the marginal cost? Because that's the first thing you reckon with when doing transfer pricing. What is the marginal cost or the variable cost? As you can see, marginal cost of the transferred output. So the marginal cost of this is still 400 naira, because 400 naira is the variable cost per unit. So marginal cost is still 400 naira. Now the question is there any opportunity cost? Of course, you accept with me that there's no opportunity cost, because division A is not selling to anybody. So there's no opportunity cost in this situation, because had it been division A has an external market and is selling at a higher price, then there will be an opportunity cost. But there is no opportunity cost in this situation. So the transfer price will now be 400 naira alone, or 400 naira only. So there are different scenarios like that. So let's say for example, in this case, 40,000 units is still produced, everything is still the same, just that the external demand now is now 20,000. So the external demand is 20,000. That's the external demand. Let's calculate the transfer price in this situation. In this situation, there will be two different transfer price, and I will show you how we go about that. So number one, we need to calculate our marginal cost, which is our variable cost, right? Now our marginal cost, what's our marginal cost? Our marginal cost, which is our variable cost, is 400 naira. That's the variable cost of producing, 400 naira. Now in this situation, what is the opportunity cost? What is the opportunity cost? If I'm selling, if there is only 20,000 units that my external consumers are willing to buy, definitely me selling 30,000 units to division B means that I will only be able to sell 10,000 units to division A. In this situation, what am I going to do? I'm going to say, now look at this. Marginal cost is 400 naira, right? The and don't forget that division A will be selling 20,000 units to external customers or external market for 1,000 naira each, because that's the price per selling price, 1,000 naira each. Now, for these 20,000 units that division A will be selling to external consumers, what is the opportunity cost on it? So the opportunity cost, so opportunity cost of 20,000 units, opportunity cost of 20k units, opportunity cost of 20,000 units will be now 600 naira per unit, right? So for the first 20,000 units, so I'm going to sell the 20,000 units with the opportunity cost that is relating to it. So marginal cost is 400 naira. Opportunity cost of selling 20,000 naira for 20,000 units is 600 naira. But for the remaining 10,000, that B, there's no opportunity cost on it, because A can only sell 20,000 to external consumers, and out of that 20,000 naira, 20,000 to external consumers is selling it to division B already. So the opportunity cost on the 20,000 units is selling to division B is what? 600 naira for the whole 20,000 units. Now for the remaining 10,000 units, now the selling price, the marginal cost rather, is 400. But is there an external market for the remaining 10,000 units? Because If division A is selling 20,000, division A is still left with 20,000 units. I hope you are getting what I'm trying to say. Division A selling 20,000 is still left with extra 20,000 units. So division B now comes to buy out of the remaining 20,000 units that is left, buying 10,000 naira from them, 10,000 units. So the question is there any opportunity cost for the remaining 20,000 units? Of course, no. So we will only be selling, opportunity cost will now be new. So the first 20,000 units that division B will be buying, will be selling it for 1,000 naira per unit. And the last 10,000 units that division B will be buying, will be selling it for 400 naira each. So please note, this is how we deal with, I've explained the concept of transfer pricing in just few minutes now. So this is how we deal with, or this is how we attempt questions on transfer pricing. Let's take a question on transfer pricing and let's see how we can put all this to work. And in our subsequent videos, we take more technical questions. Let's go. Welcome back. In this video, we'll be taking a question, a very simple question, and in our subsequent videos, we look at more technical questions. Let's go. Division X is a profit center which produces three products, A, B, and C. Each product has an external market, but B can also be transferred to division Y. The maximum quantity that might be required for transfer is 30 units of B. Information on the three products is as follows. External market price per unit for A 84 naira, B 81 naira, C 70 naira. Variable production cost in division X per unit 57 naira, 41 naira, 49 naira. Labor hours required per unit in division X 3, 4, and 2. Maximum external sales in units 1, 4, 875, 525 required. If labor hours in division X is limited to 1,170, what is the appropriate transfer price for a unit of B? For B, if labor hours in division X are limited to 4,670, what is the appropriate transfer price for units of B? Now, let me say this. This question, like I said, for you to be able to understand this question, you need to go and understand the concept of limiting factor. Yeah, not just the one I mentioned earlier. If you don't know limiting factor, I think I'll be dropping the link aside under this one also, because I have a video on it already. I'll drop the link under this one. So please make sure you watch out for these things, because it's very important for you to understand this. There are some other subsequent topics you need to know. So let's get to work. So the question now asks that if labor hours in division X is limited to 1,170, what is the appropriate transfer price for a unit of B? Now, for us, if there is any limiting factor, there are some things we do in the sense that we calculate the contribution per unit of limiting factor. And how do we do that? Let me show you. So we have three products that has been produced. Product A, product B, and product C are the three products that the company produced, right? Now the question is, how do we calculate? First thing we need to do whenever we have a limiting factor. Now the limiting factor in this question is the hours. They said we have our hour is limited to 1,170. So we need to estimate in order of which product we should produce, or which product should we rank as the most important, since we have our hours to be limited. So which one should we produce? Which of the products should we produce more that will give us more profits? That's what we want to do. So we need to calculate the contribution. So how do we calculate the contribution? Contribution is simply your selling price minus your variable costs. As simple as that. So for each of these products, what is their selling price? By giving external market price per unit for, so the sales for A is 84 naira, for B is 81 naira, and for C is 70 naira. So this is their external selling price market. So what is their variable cost per unit? From the question, we're told that the variable production cost in division X per unit is 57, 41, and 49. So we have variable cost. Variable cost. So we're given as 57, 41, and we have 49. So we do the maths. If you do the maths, this should give you 21, 40, and 27. So this is the contribution per unit. Contribution per unit. So after getting the contribution per unit, the next thing we need to get is, since the limiting factor is hours, how many hours does it take to produce A, B, and C, so that we will get the contribution per limiting factor. So let's go. From our question, we're told that our labor hours required per unit for, so we go labor hours. So for product A, we have 3 hours. For product B, we have 4, and for product C, we have 2. So if you divide 27 divided by 3, you have 9. 40 divided by 4, you have 10. 21 divided by 2, you have 10.5. So now this is the contribution per limiting factor. Contribution per limiting factor. So why do we have to do this? We have to do this because so that we can get which product is very, very important for us to produce first, that will give us higher contribution, higher profit, if we, because our labor hours is limited. So now in this question, this one give us 10.5, this one give us 10, this one give us 9. So this is the first product that we should prioritize, the second product, and the third product. So in case of the limitation, product C should be the one that we should produce first, followed by product B, then followed by product A. So let's go. They now ask us that if labor hours in division X is limited to 1,170, what is the appropriate transfer price for a unit of B? Now, if we are to produce product C first, product B, don't forget our total labor hours that is available in this question, according to what we were told. We told that labor hours is limited to 1,170. So let's go. We want to produce product C. So we will go product C first, product B, and product A. So for product C rather, what is the market demand for product C? Market demand for product C from our question, maximum external sales in units for product C is 525 units. That is the market demand. So market demand is 525. What about for product B? For product B, market demand is 875 units. 875 units. Now, how many hours does it take to produce product C? It takes product C, it takes 2 hours to produce product C. So if you are producing 525 units and we are using 2 hours on one unit, definitely total hours that we spend is 525 times 2. So this is our external market demand. And according to what we've done, product C will give us the highest contribution. So we should produce product C first. So if you are producing product C, market demand for product C is 525 units. So for us to produce that 525 units, we need 2 hours for each product. So 525 times 2 hours, that will give me 1,050 hours. So out of 1,170 hours, I have used 1,050 hours. So 1,170 minus 1,050, I have 120 hours left. So 120 hours left after producing product C. Now, I have 120 hours left. I have to use the 120 hours. I have to use it to produce product B. So how many hours does it take to produce product B? It takes 4 hours. So 120 hours time divided by 4, because if I'm using 4 hours to produce one, then I have 120 hours. Then 120 hours divided by 4 will give me total number of goods I can produce. So 120 divided by 4 will give me, I can only produce 30 units of B. I can only produce 30 units of B. Please, if you don't understand, I will ask you to go back a little or go and watch videos on transfer pricing, limiting factor rather, for you to understand it better. In this case, I have 1,170 and product C will be the one to give me the highest profit. So I should produce product C first. So 525 times 2, 1,050 naira. I'm left with 120 hours. So 120 hours divided by 4 hours that is required to produce unit of B. I can only produce 30 units of B. Definitely, I cannot produce A at all. That's what it means. So now, in this situation now, I have 30 units of B to sell. That's all I have. And don't forget that in the question, they told us that each product has an external market, but B can also be transferred to division Y. So I have 30 units of B that has an external market, and I can also transfer it to product Y. So how am I going to determine the transfer price? That's the question. How do I determine the transfer price? It is the marginal cost of B plus the opportunity cost. Now, what is the external selling price for product B? The external selling price for product B is 81 naira. We have already seen it in our calculation, 81 naira, right? Now, what is the marginal cost, the variable cost of producing product B? We've done it here. Variable cost is 41 naira. So marginal cost is 41 naira. Then what is the opportunity cost? Because the external market demand for product B is 875. Yes. Maximum sales in units. Yes. So external demand for product B, they are demanding 875. And I only produce 30. Definitely, I can sell all these old 30 to the external markets. So if my marginal cost is 41, my opportunity cost can never be nil. My opportunity cost will be 81 minus 41, which is 40. So which is what? 40. So if I sum it together, 41 plus 40, I have 81. So this will be my transfer price. So this will be the price at which division X will transfer to the internal other division. So, but in the case whereby there's no, adding me, there's no external price, external market for division B, that the demand for division B is 0, then the transfer price will just be 41 naira alone, the marginal cost. So it says if labor hours in division X are limited to 4,670, what is the appropriate transfer price for a unit of B? So now 4,670 is the total hours that is available. Now instead of 1,170, so labor hours that is available, labor hours is 4,670. 4,670. So from what I've done earlier, C will be the first product, followed by B, followed by A. So C, B, A. Same thing. C 525 is the external market demand times 2. We still get the same thing. 525 times 2, which gives us 1,050 hours. 1,050 hours. Now, division B, the external market demand is 875. So for product B, 875 is the external market demand. Let's see if we can still produce the whole of 875 from our labor hours. So 875 times, what is the labor hours required for producing 1 unit of B? This is it, 4 hours. So 875 times 4, 3,500 labor hours. Now 3,500 labor hours plus 1,050 naira labor hours, that gives us 4,550 labor hours. So 4,550 labor hours out of 4,670 labor hours. What do we have? So 4,670 minus our answer, that gives us, we are left with 120 hours. 120 hours. So after producing product C and product B, will be left with 120 hours to produce product A. So how many units of product A can we produce with 120 hours? So the question is, how many hours does it take to produce product A? 3 hours. So 120 divided by 3 because we can only produce 40 units of product A because we have 120 hours and it takes 3 hours to produce product A. So 120 hours divided by 3 hours it takes, we only produce 40 units of A. So 40 units of A times 3 will give us 120 hours. So now they now ask us that what is the maximum quantity that might be required for transfer is 30 units. So they ask us that what should be the transfer price for product B? That means that products the other division only needs 30 units. What is the marginal cost? The marginal cost is simply the variable cost, which is how much? 41. Yeah, variable cost 41 naira plus the opportunity cost. Now the opportunity cost of producing, look at it though, the opportunity cost of producing 30 units, that is the extra 30 units that is required by products by other division. What is the opportunity cost? Now the opportunity cost, if I want to produce that 30 units, the question is how many hours am I going to use? Since, let's do that roughly. Now this is division B, or product B rather. Now I want to produce 30 units because I have been able to cover what I'm going to sell to external markets. So now to produce extra 30 units that is required by the other divisions, let's see. Now I'm going to be needing, since it takes 4 hours to produce 4 hours, it takes 4 hours to produce 1 unit of B, then times 30, then times 30, because the other divisions only need 30 units. So and it takes 4 hours to produce one. So 4 times 30, that gives us 120 hours. So that gives us exactly the same hours that will be required for us to produce 40 units of A. Now look at it, listen very, very well. The opportunity cost of producing extra, we've been able to meet our external demand for this. Without any internal transfer, we'll only be able to produce extra 40 units of A. So for us to be able to meet the internal transfer demand, which they only need 30 units. That means that we need to spend extra 120 hours. So if you are spending extra 120 hours, we will not be able to produce product A because that's the hours we will have used to produce product A. So now the opportunity cost will now be the price, the opportunity cost of producing product A. So let's go. Now for product A now, what is the opportunity cost? The opportunity cost is that if we have not produced this 120, if we have not produced this for the other division, we will have make. Now what is the selling price of division A? 84 naira. Now what is the variable cost? 57 naira. We will have make extra 27 naira from these 40 units of A that we are producing. So the transfer price will now be marginal cost of 41 plus the opportunity cost, which is 27. Because now let me come again. The If we have produced 40 units of A without 120 hours, we will have gotten 27 naira contribution from those 40 units. So that means that we are foregoing those 27 naira contribution to be able to produce more 30 units of B. So the opportunity cost will now be the 27 unit naira let go, rather, sorry. The 27 naira we let go will now be my opportunity cost of producing this. So that our final answer will now be 41 plus 27, and that gives us 68 naira. So the transfer price will be 68 naira. As simple as that. If you don't understand, I advise you to take it back. In our next class, we take a very more technical and complex questions we solve together. You see your number one tutor on this YouTube channel. Please click the red subscription button. I'll see you in my next video class.